Thank you everyone for joining. We're going to get started in just a second. Good afternoon, everyone. I'm Olivia, and I'd like to thank you for attending today's webcast. Today we'll be presenting Insurance Tax and Financial Reporting Update, which will be led Arash, Tim, Florie, Neil, and Abdullah. Before we begin, I'd like to review a few housekeeping items. First, we encourage you to ask questions. To do so, please send them to us using the Q&A box in the lower left-hand side of your screen. We will try to answer all of your questions during the webcast, but if a fuller answer is needed or if we run out of time, your question will be answered later in email. Second, to earn the available 1 CPE during today's webcast, you must listen to at least 50 of the presentation and answer 3 polling questions. Please note that you must be logged in individually to receive credit for today's webcast. If you are attending as a group, only the individual who is logged in will receive credit. If you've completed the requirements, your certificate will be available for download at the end of the webcast. I'll walk through how to download your certificate after the presentation has concluded, so please stay on the line. Lastly, you can download a copy of today's presentation from the green Resource List button at the bottom of your screen. Here, you will also find our webcast Frequently Asked Questions, a document which offers some basic troubleshooting information and other useful tips. Again, this can be found under the green Resource List button at the bottom of your screen. Now, thank you once again for joining. I'll hand it over to Arash.
Hi, everyone. This is Arash Barkhordar. I lead Mazars U.S. Insurance Tax Practice, and excited to be part of this webcast, and welcome, everyone. As we look at the agenda and the topics that we're going to be covering, it's basically 2 areas of focus. One would be on the Pillar 1 and Pillar 2 proposals, which will focus on the impacts on the insurance industry. As we will see, Pillar 1 is expected to have less of an impact in the insurance industry, so our focus will be more on Pillar 2. And then after that, we'll go into the IFRS 17 guidelines that are, coming to do and will become applicable January 1, 2023. And also focus on, the impacts of those new guidelines and requirements for the insurance industry and the tax considerations as part of those. One point that I wanted to highlight, these proposals and new requirements definitely have ripple effects, especially with respect to Pillar 1 and Pillar 2, where, these proposals look to add additional tax, for example, a minimum 15% global tax, which, we'll go into the details. Each country would look to capture that extra tax themselves. For example, the U.S., there are proposed regulations and guidelines with respect to U.S. taxation. I know the U.K. Just, finalized their proposal. So the ripple effect of these guidelines is mainly in terms of local legislation for countries to capture that top-up tax to get to 15%. So it's not just these rules that will impact insurers, but the expected local legislation for the jurisdictions that would be applicable for these guidelines. With respect to IFRS 17, there's counter or a similar gap pronouncement, which is ASU 2018-12. We won't get into the details of that, but we'll talk about some of the tax considerations of that gap guidance, which is similar to the IFRS pronouncement. Tim, if you want to start on Pillar 1.
Sure. Thanks, Arash. Tim Evans, I'm a principal in the international tax practice here at Mazars. So just by way of background, I think it's widely understood that digitalization and e-commerce have really played a pretty transformative role in how businesses are structured and operate. and the traditional structures that require physical presence have kind of been undermined, and in the process, governments have not always been able to tax economic activity that arises in their jurisdictions. So, in recognition of that, the OECD has been working, really since 2015 and slightly earlier with its base erosion profit shifting initiative, but working to address this issue on the challenges that are presented by the digitalization of the economy. And Pillar 1 and Pillar 2 are really the outcome of this work. So essentially, Pillar 1, it addresses the taxing authority of a jurisdiction in the absence of physical presence, so-called market jurisdictions, so basically jurisdictions where users and consumers are located. They're now receiving a taxing right over a portion of residual profit. So from a scoping perspective, this is very limited at the moment. We're talking about multinationals that have global qualifying revenues above 20 billion euro, as well as a profitability greater than 10%. At the moment, it's thought that about 100 companies worldwide would fall within that scope. But as Pillar 1 is implemented and through successful implementation, it is expected that in due time, the threshold would be reduced from 20 billion to around 10. So obviously, that would greatly increase the number of groups that are subject to these rules. From a contents perspective, there are really three components to Pillar 1. You've got Amount A, which is basically the new taxing right. So that's a share of residual profit that's going to be allocated to market countries. Uses a formulaic approach, and it's only applicable to the in-scope groups. Then you've got Amount B, which is a fixed baseline return for marketing and distribution functions based on arm's length principles, and this aspect of Pillar 1 would be broadly applicable, not just to those groups in scope. And then there's also a tax certainty mechanism built in. So Pillar 1 provides various dispute prevention and resolution mechanisms just to ensure that, for example, there's no double taxation arising from any of this. And then not a tax, but 25% of the profit that exceeds that 10% threshold ends up getting allocated to market jurisdictions under Amount A. And so, importantly, especially for this audience, regulated financial institutions are excluded from the scope of Amount A. Arash, would you like to elaborate briefly on this exception?
Sure. Yeah, so basically, as we all know, insurance companies are highly regulated, and there is this regulated financial institution exclusion, the RFI exclusion, which basically means that the insurance industry would be excluded from the application of the Pillar 1 rules. There's a little bit of a question that had arisen with respect to reinsurance. The OECD published responses to some questions with respect to whether reinsurance should be included in the exclusion or not. The industry responded unanimously in letters to the OECD that there should not be a difference between reinsurance and regular insurance, and it should not be taken out of the exclusion. The expectation is that reinsurance would also be part of this exclusion, but until things are finalized, it should still be monitored. But for the most part, the expectation is that insurance industry would be excluded. There is one caveat to that.
Sorry, Arash.
Yes.
Sorry, Ash. Sorry, it's Neil Rolfe, head of insurance tax from Mazars. That's absolutely right. What you just said. It was quite interesting watching the debate. Most of the debate around trying to get reinsurance into Pillar 1 was led by the US, and the reinsurance centres, the UK, Bermuda, Switzerland and Germany, fought a rearguard action. It appears that they've been successful, and that actually in the final outcome, reinsurance will be outside of Pillar 1, so anything to do with the insurance industry will not be classed as Pillar 1 number. That predominantly means that the likes of Swiss Re and any other reinsurance groups are now outside of Pillar 1, and it's focused much more on the likes of Amazon and Apple.
Okay, great. Yeah, and Ian, he leads our UK insurance tax practice, and thanks for joining. So yeah, just the other caveat is captives. Basically, captive insurance it's not as regulated as a regular insurance company, so that aspect is actually included within the Pillar 1, so it's not part of the RFI exclusion. So any company that reaches those thresholds of 20 billion global revenues and has a captive would be included in that. Now focusing on Pillar 2, which is more applicable, so the thresholds are lower. So we have now $750 million or euros, and they're kind of same at this point with the exchanges. Any company in groups of companies with more than $750 million, including insurance companies, would be subject to the Pillar 2 requirements. And basically, Pillar 2 would allow jurisdictions to collect taxes in respect of associated companies that have paid less than 15% tax on profit. Again, any group that has less than 15%, there would be top-up tax to get to that 15%. And really the question becomes, how do you calculate that, top-off tax, and which jurisdiction would be able to, impose that extra tax to get to that level. And again, as mentioned, there are proposals within different countries because each country would want to get that extra tax themselves. And if you have in the US and they have entities in Europe or other jurisdictions, they would want to get that extra tax. So Tim, do you want to go through the details?
Sure. So as Arash touched on, the idea here is that multinationals would pay a minimum level of tax regardless of where they're headquartered and which jurisdictions that they choose to operate in. So, it's thought that about 2,000 companies worldwide would be subject to Pillar 2, and that these rules would result in approximately 150 billion in additional tax revenue around the world on an annual basis. So the Pillar 2 is really sort of two regimes working in tandem. You've got the globe regime, which consists of an income inclusion rule and an undertaxed payments rule. We'll go into a tiny bit more detail on these. And then the second aspect of the regime is a subject to tax rule that requires a minimum level of tax on certain payments between connected parties, where those payments are deemed to have a heightened base erosion potential. So again, just to reiterate the scope, it's multinational groups where the group has annual revenue of 750 million euro or more, and that's tested by at least 2 of the 4 years preceding the tested year having consolidated financial statement income above that threshold. So, just to point out that this really aligns with country-by-country reporting thresholds. So, generally speaking, if you're doing country-by-country reporting, likely the globe will apply to you as well. And then lastly, just a point on the multinationals for scope. You don't need a legal entity in multiple jurisdictions. Having a permanent establishment would be sufficient. That brings us to our first polling question. And the question is, what is the expected impact of the Pillar 2 rules on your company? I'll give you a little time to answer that.
Yeah, and as was mentioned earlier, clearly, the impacts of Pillar 1 are going to be less than Pillar 2. And, these provisions are expected to come into play. A lot of companies have done modeling in terms of assessing the impacts. And as the rules in each country is finalized, the impact may be different. But, for a lot of companies, just getting to a place to be able to make the calculations is a big process.
So we'll move on to the answers. So the majority, or I guess 26.7% are expecting a minimal impact, 20% a significant impact, 20% haven't determined their impact, and a smaller percentage are not anticipating any impact at all. I think importantly from a U.S. perspective at least, U.S. parented multinationals, the level of impact is really still up in the air, as we'll talk through on some of the later slides. So some key definitions. The GLOBE rules, basically consisting of that income inclusion rule and the under-tax payment rule. This sort of is the framework for the 15% minimum tax. The income inclusion rule, this is a top-up tax imposed on the ultimate parent entity of a multinational group with respect to the low-taxed income of any of its constituent entities, whether a subsidiary or a permanent establishment. And this brings you up the top-up tax to that 15% rate. Multinational, of course, assets or employees in more than one country. The qualified domestic minimum top-up taxes. Because the top-up tax of the inclusion rule is imposed on that ultimate parent entity, what the QDMTT does is allow jurisdictions the opportunity to enact legislation that would sort of take priority over that income inclusion rule. So basically choosing to tax the entities' actions themselves. So this wouldn't really impact how much tax a group is paying, but it would impact where the top-up tax is paying and sort of may push it down into the subsidiaries instead of it being at the parent level. There are a few jurisdictions, certainly, that are known to be considering implementing a QDMTT. But I think, there's a lot of complexity that goes into that, from a local legislation perspective, because the rules have to be consistent with Pillar 2, and you also got to determine whether you would want that rule to apply broadly or only to groups that are in scope for Pillar 2. Because, of course, you may have countries that impose a low corporate tax rate, and they still want to be able to incentivize investment by keeping rates low for anyone who's out of scope of Pillar 2. So some considerations for countries to be thinking about that. The subject to tax.
Yeah,
rule,
I think. Sorry, it's Neil again. Sorry, I think that's probably one of the most interesting points around this is the domestic minimum tax. So I think Ireland have already announced that they intend to increase their tax rate to 15% for people who are CBCR reporters, currently 12.5%. I think talking to countries like Bermuda, they are currently at 0%, and they don't anticipate that being feasible in the long term. The UK legislation, which was released last week in draft form, has a white list of domestic minimum tax countries, and I think what we will see over the next few months, really, possibly the next year, is jurisdictions trying to firm up exactly how they're going to handle this, how they manage to keep their tax takes the same as it is now, more or less, but without impinging upon their ability to meet the Pillar 2 rules. It's going to be a bit of an interesting sphere, I think, and that also obviously includes the US with the changes that will happen probably hopefully get enacted to make the US equivalent in that realm as well.
Neil,
Yeah.
those are great points. I mean, with respect to Ireland, obviously, it's been a hub in terms of a low taxing jurisdiction. A lot of insurance companies, have considered Ireland. Are you hearing anything locally in terms of companies might be considering moving out of Ireland, since they may not be getting that benefit, the tax benefit anymore?
So Ireland, the difference is between they're basically taxed at 12.5%, and they will move to 15%, but maybe with some sort of wrinkles in their local legislation that means that it's more or less 12.5%. Is not a big deal for Ireland, I don't think. I think it's a much bigger deal for reinsurance groups that are tracking profits into very low tax jurisdictions. So Bermuda is the obvious one where it's going to be a concern, where they're currently taxed at 0%, and Cayman, and anywhere where you've got offshore captives from a US perspective. I mean, if it's not all about the regulator and it's all about the tax breaks, I mean, that's going to put some damage into that business model, isn't it?
Definitely. This like what I was mentioning earlier, the ripple effects, right? These changes in local tax rates. We have a lot of clients that have made a 953D election to be taxed in the U.S. for various respects, a lot of it tax planning, but with these changes in tax rates, those need to be kind of revisited. So a lot of ripple effects, a lot of considerations. This is kind of a global tax reform in the making in the next 2 years, I would say. So it's the impact is going to be very significant, and companies need to monitor not just not just the U.S., which we'll cover, but other jurisdictions as well.
I think that's totally the case, right? So as we're looking at people at the moment, transfer pricing is increasingly important for tax, doing things on an arm's length basis, but nonetheless, a lot of groups have a global pooling vehicle. And in a number of cases, that global pooling vehicle is in a low tax jurisdiction. It's and they've arranged things to deal with the US tax, to deal with the local tax, all of that, and all of that over the next 2 years is likely to change. And so people are going to have to assess whether what they've currently got is going to be optimal in what will be a relatively new world.
Yeah, great points, Neil. Just very briefly on the sort of the steps here. So basically, Globe is going to work as follows. You compute your effective tax rate for each constituent entity in the group. You're then going to have a top-up tax computed based on those effective tax rates that are below 15%. And then determination as to whether that liability exists at the parent entity or with the constituent entity, and then applying the income inclusion rule and any under-tax payment rules. So this is a common approach, Globe. It's really up to inclusive framework members to enact and implement legislation that's consistent with these general rules. From a timing perspective, I think the important thing to note here, despite the ambitious timeline of hoping that nations would be implementing legislation in 2022 with a view to having 2023 be the implementation date for the income inclusion rule, I think that's going to be pushed back a little bit. But Neil, given that the UK has just recently put out its proposed legislation, what are your thoughts on timing?
Yeah, I mean the UK agreed. The EU put something out that basically said that they weren't going to be able to do it this year for implementation next year. I think the UK agreed and they've pushed it back. So I think the first implementation year will be probably 2024, then there'll be an 18-month window to report. So, I mean, there is still a little bit of distance between when it will actually come into force, but these things tend to creep up on you a little bit quicker than you think. And the clients that I've been speaking to about it said that to do it for a 2023 year end and to turn their CBCR reporting, which is basically just a report that doesn't mean anything and has not had a lot of attention, but into something that actually means something fiscally worldwide, is going to take a lot of effort, and there was no way at all that they were going to be able to do it during next year, to report at the end of next year. And so they think it's turned something that was basically impossible into something that's sort of really quite difficult for those groups that are impacted. And unfortunately, it looks like virtually everybody, at the way the rules look at the moment, virtually everyone who's above the 750 million euro global income, global revenue, are going to have to do something. You know, it's not going to be optional. And gradually, and people will, even low tax jurisdictions will implement it, because otherwise the countries that adopt first will basically steal all the tax revenues for the entire group. And so
right.
That's, you know, it's being crafted very well from an OECD perspective. There is really no opt-out for the low tax jurisdictions. If they don't implement the tax themselves, it will get collected by somebody else. And you know, if you're the US, you don't want it to be the UK. Do you see what I mean? It's quite clever in that way.
Yeah, absolutely. And then just final, the UTPR, I think that although that was originally scheduled for 2024, that looks like it'll probably be delayed till 2025 or even 2026 at this point.
Yeah, I mean, UTPR is the real kicker, isn't it? That's when you actually really steal other people's money. You know, that was always scheduled to be a year later. I mean, who knows when it will actually come in? But you're right. It will follow. In most places, it is supposed to follow a year after the IIR.
Yeah. So that brings us to the U.S. And really here everything sort of turns on, you know, really whether guilty ends up being modified to meet the requirements of Pillar 2. There's a couple of primary barriers there, really. So one, currently guilty has an effective rate of 10.5% when you take into account the Section 250 deduction. And also guilty is, of course, not imposed on a jurisdiction-by-jurisdiction basis because you're allowed to offset tested income of some CFCs by tested losses of other CFCs. So really, you know, the tax rate and the non-country by country basis of guilty are problematic from a Pillar 2 perspective. So certainly there were proposals to modify guilty. Currently it doesn't look like those will pass. There is a minimum tax, 15% minimum tax on financial statement income still alive with Congress, although that also doesn't have a sort of country-by-country allocation. So, you know, as written, I think also falls short of what's required for Pillar 2. So how the U.S. is impacted, you know, really particularly U.S.-parented multinational groups, I think it's still up in the air. There's definitely indications that Treasury and the OECD are going to look for a solution, even if guilty isn't wholesale amended, but, you know, some way of tracing, some tracing mechanism within guilty that would help it to qualify for some, you know, alternative approach that may be a workaround to permit guilty to fall within the Pillar 2 rules. So U.S. definitely, how this is going to play out remains uncertain at this time. And I think from a practical perspective, that the fact that we don't really know where the U.S. is going to come out impacts, how you can gauge the impact of Pillar 2 on your group. So I think at this point, we're really in a sort of a monitoring and perhaps modeling phase. So, certainly monitoring the jurisdictions that you do business in to, see whether they'll be imposing or implementing a QDMTT, seeing how the local legislation develops, maybe modeling the impact of some of this. But I think also considering, the additional compliance burden that you may have in jurisdictions that are impacted by this.
Okay, great. So I guess we get to our second polling question. What is your company's current status of Pillar 2 implementation? Far along and on track, still assessing potential impact, need more resources? That might be a question for a lot of folks. Pillar 2 is not expected to have a significant impact, none of the above. We'll give folks, a couple of seconds to answer these questions. And as Tim was mentioning, clearly the impact of Pillar 2, the timing may be pushed off a little bit, but insurance companies, obviously, as they look to price products, modeling and projections are always a big item and a time-consuming effort for tax departments. So being able to project where the tax rate might be and those aspects are always a big ask for the tax department. So this is something that's going to have a big impact on the tax departments of insurance companies specifically. Okay,
yeah,
so
I think that's right. While we carry on waiting, what we're seeing is that tax departments are being asked by their CFOs and CEOs and ultimately the board, what is the impact going to be of this? And obviously it's uncertain at the moment because we don't have final rules anywhere and we just don't really know. But people are being asked to come up with something now, and it's complex to deal with, and it's an additional resource constraint, as you say. When we get into implementation, there will be additional resource, but there's also a sort of trying to understand right now what our best estimate of the impact's going to be, and that's what we're helping with people with right at the moment.
Yeah, 23% that they need more resources, and that's something that I've heard for conversations with my colleagues in Europe, Switzerland, France, the UK, Germany, Canada. Everyone says resources, especially on the tax side, on the insurance space, but overall it's going to be an issue. And as these rules become more fermented and finalized, the resource needs are going to continue to grow. And 38% still assessing the potential impact. Moving forward to IFRS 17, again, as mentioned, so this is a new requirement for financial statement purposes with respect to insurance companies, and the impact from a tax perspective. There is going to be an implementation adjustment for book purposes, which we'll discuss at the end how that might impact companies from a tax perspective. So, Florie?
Yes, thank you, Arash. Good afternoon, everyone, and thank you for joining us today. Real quick, as a way of introduction, my name is Florie Bourrel-Heleine. I am a senior manager in our New York insurance practice. I have more than 15 years of experience in the insurance industry, whether in France, where I came from, or in the US for the past 7 years. And so, yes, today we will provide this high-level introduction of IFRS 17. And because it's such a rich and complex standard, what we wanted to focus on and mainly focus on, in addition to the timeline, is the financial statement impact. So how does that translate? How does IFRS 17 translate in balance sheet and P&L presentation? And what we'll also focus on more at the end of the presentation are the tax considerations, and that's what will be discussed by Arash and Neil and myself at the end. So just to start with, why IFRS 17? And as a general introduction, I think it's important for everyone to bear in mind that IFRS 17 intends to be the first truly international and comprehensive IFRS standard for insurance contracts. And it will require all insurance contracts to be accounted for in a consistent manner, and mainly replacing today's multitude of different approaches. Because what everyone needs to keep in mind is that historically, when IFRS 4 was issued back in 2004, it was meant to be an interim standard, while the IASB was discussing with stakeholders a new standard on insurance contracts. And what it has been for many years is what we call a stopgap measure, which allowed insurance companies to use or report using their old national standard, which, as you can see in this slide, led to divergent results, lack of comparability between countries, between contracts, and also lack of transparency, because basically the disclosures were not even necessarily aligned. So that was obviously a very unsatisfactory situation, but it's a big undertaking, and that's why it took so many years to get to this final IFRS 17 standard. And so real quick on the roadmap, but I will really go pretty quickly on that. I just want everyone to understand that there was a first exposure draft that was issued and took many years of discussion and discussions between stakeholders that led to the first publication of IFRS 17 in May 2017, which initially had an initial date as of January 1st, 2021. But even this draft standard, led to additional new discussions, mainly on how to address implementation challenges or even specific topics like reinsurance that needed additional discussions among the parties. And so that's why the final amendment was actually only published 2 years ago in June 2020. So that's the final amendment publication. And the first time application, as you said, Arash, is January 1st, 2023. And even that, bear in mind, it's January 1st, 2023, but it will require insurance companies to present a comparative period. So if it's applicable January 1st, 2023, it means that you have to have your two balance sheets, 2022 and 2023, but also your opening balance sheet as of January 1st, 2022, available for comparative purpose. So that's a lot. That's a lot that needs to be done for this first-time application. And in the lower part of the slide, we display the information for IFRS 9, because again, bear in mind, those two major standards go hand in hand. And even though the first-time application of IFRS 9 was 2018, insurance company, they got what we call a deferral period option, so that they can apply simultaneously IFRS 9 and IFRS 17 on January 1st, 2023. We see that some of our clients, though, have decided to apply IFRS 9 earlier, mainly for operational reasons, because they just don't want to be in a situation where they adapt two big standards on the same year. But that's the overview of the timeline, and I think it gives you the overview of the complexity of the standard and how long it took to get to something that's accepted or more or less accepted by the industry.
Right. Florie, just a quick question. With respect to the timeline, I think for SEC public companies, so it's January 1, 2023. Non-public companies, do they have a deferral period? Can they push this off? I know there's early adoption as well.
No, I don't think there is any differentiation for IFRS purpose. It's going to be 2023 for everyone. Yep.
Okay. Okay.
I think we have a polling question. I'm going to push this one. Yep. So, and you mentioned, Arash, we don't talk about US GAAP, but we wanted to get a sense of which standards you're dealing with nowadays. So the question is, does your company report in IFRS and or US GAAP? So first answer is IFRS only, and we suppose local US stat, US GAAP only, and local US stat. You have both IFRS and US GAAP and local stat. You have neither IFRS nor US GAAP, but you may have an insurance company and report in local US stat. Or you are other, meaning you don't use, you don't have an insurance company, you have more like an MGA, TPAs or whatever, or you report in another standard. I'll give you a few seconds to submit your answers.
Thanks, Florie. And I think the point of this question is like, even if you're not going to be reporting IFRS 17 on a group-wide basis, if from a local basis you have to report IFRS 17, you will end up with some deferred tax or some current tax issues relating to it, and you know, that can end up being quite complicated.
Yeah, absolutely. And here we also target any US based insurance company that have subsidiaries in IFRS country. So that can lead to indeed dealing with many different standards. Okay, so let's see what we have.
So I'll give an example. I have a client who is headquartered in Canada, which will be reporting on IFRS 17, but they have decided on a local GAAP basis to continue reporting on FAS 102, the UK GAAP. That causes them a massive amount of difficulties because they have to sort of reconvert everything into IFRS 17 on a local basis. It's not just as quite straightforward, is it, as are you IFRS 17 as a group or not? It's are your entities IFRS 17? Do you have any impact from IFRS 17 of a material nature that you as a tax group are going to have to explain to your board?
Absolutely, and you have to manage as well local disclosure, everything that's IFRS 17 related, and that will be embedded in your financial statements, the notes to the financials. So interestingly, we have a majority of US GAAP only participants, but we do have some of you who report in both IFRS and US GAAP. So you are both impacted by IFRS 17 and the long duration targeted improvement standard. So interestingly, and you have to manage local US tax. So that's quite of a challenge indeed. I think we want to move to the next part of this presentation, which is going to be displayed by Abdoulaye Traoré, who is an actuary and manager in our US insurance practice.
Yeah, thanks for the introduction, Florie. So on this part, we are going to focus on the presentation of IFRS 17 and IFRS 4 balance sheet and P&L comparison. So regarding the balance sheet, I mean, we're not going to focus on the assets. They are mainly assessed in fair value. You have some specificities depending on IFRS 9 and IAS 39. We're going to focus way more on the liabilities side. So for IFRS 4, as Florie mentioned earlier, the technical results are based on local gaps. And there's an additional requirement of adequacy, which means that the reserves that are booked should be sufficient compared to a best estimate, to an actuarial best estimate. So that's the main constraint, I mean, regarding the building of IFRS 4 balance sheet, and that doesn't give lots of information regarding the uncertainty in the reserves. And on top of that, you have some additional layers like shadow accounting for unrealized profit and losses on assets and the OCIs. So when we move to IFRS 17 balance sheet, we can see that the liability side is way more divided. You have three main parts that we have decided and three components that we have decided to present you. The first one is the best estimate in IFRS 17, which means the average present value of future cash flows, which is, let's say, the reference that would have been used under IFRS 4 to check if the technical results are sufficient or not. You have an additional layer, which is the risk adjustment, which represents the uncertainty around the amounts and the timing of these amounts that we anticipate as future service to provide as an insurer. And then you have the contractual service margin, which is an additional reserve for future results, meaning that when a contract first incepts, you will not recognize, let's say, the future results stemming from the premium received, but these future results will be held and then recognized when the service is indeed provided to the client. So the main point on this IFRS 17 balance sheet is that it includes more information, and then just visually it can provide more information to anyone reading it, because you have a differentiation between the present value, let's say the average value of the liability, and the risk adjustment will show you, let's say, a degree of uncertainty in your prediction, and then your contractual service margin will be an assessment of future results. So it's like company valuation in some sense. So very quickly on the P&L differences. So on the left part you can see the IFRS 4 P&L presentation. So it's very classical. You have premiums, commissions, claims, expenses, and then you get your net income. On IFRS 17 balance P&L, you will not see directly the written premiums. You will see something way more like a margin analysis, very specific for insurance businesses, meaning that you'll have your insurance service results split between insurance service revenue and insurance service expenses. You'll have your financial results, operating results, etc. That margin analysis shows, let's say, a logic that is way more aligned with how insurance business is practiced, and it's built based on the reassessment of the three components that we have talked about previously on the P&L, on the balance sheet. It provides, let's say, more information because you'll have that specific margin analysis instead of having premiums minus claims. That's very usual. So the main challenge with building that P&L is, let's say, the coordination between the actuarial services that will provide all the different layers of your P&L, mainly on insurance revenue and insurance service expenses, the finance teams, and the IT, who will have to update, let's say, the information system to be able to tackle the IFRS 17 challenge. So, Florie, I'll let you take the next one.
Yes, and thank you, Abdullah. You're talking about challenges. We have one slide we wanted to go over. I think I will go very, very quickly because we would like to take some time to focus on the tax consideration. But basically, wanted to just lay out a few of those operational and technical challenges that insurance companies are facing while they implement IFRS 17. I'll just give you just one figure because I think it's very telling. The initial estimated cost of implementing IFRS 17 by the FWAG, when it was measured a few years back, was 2 billion euros for the 12 European insurers that took part on the case study held by FWAG. Since then, this amount has significantly increased, and mainly because of some of those, data information system calculation process, the work that needs to be done on the steering, new accounting logic, all those aspects that were not necessarily, anticipated to take so much time to implement. Well, just first to analyze and then to implement and create a new business as usual for those new reporting lines. So that's very that's definitely something that needs to be looked at very carefully. And if we want to consider what's important on a tax purpose, yes, the transition is something that tax people may need to be involved on. But any calculation process, any financial disclosure is also something where there may be some tax implications. But I'd like to leave some time for the polling question. So the last polling question, actually, which is related to these challenges that we have discussed. And so, if you are involved in the IFRS 17 implementation project, what is the biggest challenge for your company in implementing IFRS 17? So, calculation process and new accounting logic, governance and steering, enhanced disclosures and new KPIs. So something we may not have discussed, the KPIs, yeah. So, and wide data and information system, and other. If you may not be involved in this project yet. So
yeah, and Florie,
what you can
yeah, Florie, those are great points. I mean, really, the impact of we need to understand from a book perspective what's changing. That presentation in the financial statements, that was a big change from how it was done before, and really lining up the accounts now for tax purposes. Just the mapping of the trial balances is going to be an issue. And again, we've been focusing on IFRS, but GAAP has its own similar guidelines, which they wanted to kind of be in line with IFRS with respect to ASU 2018-12. So those aspects, understanding the impact from a book perspective, becomes a key aspect of, are you capturing the, book information correctly? Are you capturing all the new lines from a P&L and balance sheet for your tax considerations?
I think that's a really
absolutely.
good point, because they don't map that easily. So the IFRS 17 financial statements don't have premiums, they don't have claims. They're in the residual numbers, right? But if you're reporting on US GAAP and you've been tracking those into your US GAAP book numbers as pretty much standard, and then all of a sudden they disappear, I mean, what do you do about that? Or they change and they move into a different line? Are they mapped correctly? That's one of the biggest problems that I think people have. I have clients where they said that their IFRS 17 project was initially amber, moved into red, and they're now saying it's moved into brown. I think we all know what that means. That there's a lot of complication in the IFRS 17 that people will report on, possibly not entirely correctly for the first year, but it will be what it is. It will be the best people can do, and then there will be an ongoing optimization of that going forwards as people actually start to get to grips with really what they should have done to start off with, and also actually how their profit profile moves and how and how their tax profile moves. I think it's for me it's one of the most complicated areas that I've been in the industry now for about sort of 30, 40 years, and it is one of the most complicated areas that I've seen for quite a long time. And I'm quite technical, and I, with my also fellow technical friends in industry, we're struggling with it. So I imagine that it's going to be a struggle for a lot of people over a decent period of time. We just keep on trying to understand it and do better, I think, us and
right.
our clients.
Yeah, and Neil, that's a great point. I guess maybe we could wrap up the polling questions, and we'll get to really. I think the resource issue becomes a kind of a parallel issue, to get to all the complications in terms of, the mapping area is a resource issue a lot of times, and also technology is a key aspect of that. Do you have the right resources, enough resources? Is your technology aligned? I've been part of a lot of, tax technology implementation, whether it was, corp tax or one-source provision modules, and the mapping sometimes takes years to map things right from a, gap to stat perspective. And, as we look at the slides.
Well, totally. I mean, we like when I was at Swiss Re, I think we've spent about sort of 10 years developing Longview, and it still didn't properly work by the time I left. Even though it was better than it was before. Nothing is perfect, right? But it's all about the art of getting it acceptable enough for it to be materially correct, and for the controls to be appropriate, and for it to be written up appropriately such that the auditors can sign it off, and also about the reporting out to the market, making sure that whenever that is done, whether it's on a monthly, quarterly, or whatever, those reports have to, if there's a significant issue, those reports have to flag it, whether it comes out of tax, or whether it, or a tax component of the IFRS transition, or whatever. Tax has to be involved, early,
right?
And
yeah,
and it isn't always, and even when it is, it's always very difficult. That's what it's just
No, and what you said, Neil, is critical. Indeed, managing the transition to IFRS 17, and while doing so, anticipating the potential tax impact. I mean, we know there were several methods to first time implement IFRS 17. The preferred one is the fully retrospective approach, which is basically you de-recognize your insurance liabilities, and you recognize them as if you had applied IFRS 17 from the beginning, and so this has impact on the tax aspect, but more so. Lots of insurance companies also have to deal with this level of contractual service margin that they will recognize when they apply IFRS 17 for the first time. And some of the questions that arise are how will this align to the actual margin profile of the portfolio that was underwritten before and the new portfolio, and how they will also be able to communicate efficiently around those aspects.
Right. Yeah. I mean, the key aspect is understanding the book adjustments. Then, when you focus on the tax implications, and I think we covered most of these items, but just going through this last slide, the impact to deferred taxes, that becomes a key item of importance, because if your book reserves, for example, are changing. And again, ASU 2008-12 on the GAAP side as well will also have an impact on your IFRS to tax or GAAP to stat deferred taxes, and tracking of those. It is always an issue, but with this changes to the book numbers, that's definitely an area of focus. Another adjustment, the adjustment to the reserves. The book adjustment, is that going to result in a accounting method change? In the U.S., obviously for insurers, for the most part, you start with stat, which is not impacted. But, if a company has, GAAP, let's say it's a captive or a foreign insurer with a 953D election, they might be based on GAAP or IFRS, and those companies would have potential adjustments which needs to be accounted for tax purposes. I know in the UK, they're looking to have a 10-year spread, but again, those are the items that need to be focused on. And VA as well as DTA's change, those are some of the items to focus on. I think we talked about these last three bullets basically in terms of the mapping and the resource issues, and tons of new disclosures which companies need to focus on. Olivia, do you have any last comments?
Yep. Thank you everyone for joining. I don't see any questions in the Q&A box, but if you do have any final questions, please feel free to shoot them in there, and we can get back to you after the fact. As a reminder, you can download this, so feel free to download it after the fact and reach out to any of us if you have any questions. We hope you enjoyed today's webcast. So if you've completed the CPE requirements, your certificate is now available for download. You'll see the instructions on the screen. We encourage you to tell us what you thought by completing the webcast feedback form, which you will be redirected to shortly and will also appear as a link here. Please take a minute and fill out once we conclude. Please feel free to reach out to me or any of today's presenters with any questions. Thank you once again for joining, and enjoy your day.
Yeah, thanks everyone for coming, and thanks to all the presenters. I think it was a good discussion for me. Enjoyed it very much.